Hey everyone, in this video, I'm going to walk through our framework for thinking through tax strategy. We're going to cover how to think about tax and accounting. These are principles that should be your guiding light anytime you work through something financial. We'll talk about the big no-nos. These are critical rules in your business that you don't want to trip up on. And vision planning. Any strategy you think about or implement should move you closer to a bigger, better version of that life. And we want to think about that. Whether that means these are goals for your family or for your bank account. All our planning is only valuable if it moves you towards your target. We're also going to show you some specific examples of how this framework works in a modeling exercise, which I'm excited to show you. So without further ado, let's jump right into it.
Hi everyone, today we are talking about tax strategy. Today's presentation is called Year-End Planning in the Sharing Economy, Change in Planning Ahead. We're going to talk about a few things today. We'll do a quick overview of who we are and what we do. We'll cover some of the basics. If you're familiar with our coursework, you'd have seen this a few dozen times by now, but we're going to do a quick overview because it's going to feed into our case studies and strategies. By the end of this presentation, you should know how to calculate your tax liability, how to do it quickly, and you should understand how we use that as a baseline, as a springboard to jump into actual tax planning. But before we get started, we have to bring you this message from our lawyer. The information contained in this webinar is meant for guidance purposes only and not meant as direct legal or tax advice. Further, it does not give personalized legal, tax, investment, or any business advice in general. There are always exceptions, and that exception could be you. So if you want to dive deeper into any one of these topics, be sure to flag us for a one-on-one session. All right, so quickly about us, we are a team of tax and accounting experts. Our team is at about 8 now, and our partners have Big Four experience. We have a system that trains up everybody on our positions on the sharing economy, and we have project managers on our team that if it ever gets too quiet on our end, you can reach out and get a response pretty quick. So it's a team effort. No one person represents the firm. We're stronger together, and we serve you better together. A few things about us. We have been featured across publications nationally. We've been in the Wall Street Journal. We're featured on various industry podcasts. You may have come in that way. And we have testified before governing bodies. We've testified before the U.S. Congress. Recently, for legislation that came into California, we testified alongside the Franchise Tax Board, the State Taxing Authority. So we are very passionate. We are very loud. And slowly but surely, we're getting the tax authorities to listen to some of the things that we think they should do. And of course, that's a longer conversation that exceeds the scope of this presentation. So let's get back to the basics. So we always talk about when you look at sharing economy income, when do you report? And the answer is going to be 99% of the time, always. So the rules say if you do earn $400 on any platform, you have to report that income. And we'll get into the reporting threshold for 1099Ks a bit later because those thresholds are really high. But the punchline is going to be, even if you don't get a 1099, you do have to report that income, and we can share why a little bit later. Accounting-wise, we want to be very clear on one thing, and that is that we care about net income, not revenue. Sometimes you'll hear people talk about earnings. Sometimes you'll hear income, but it means the total amount earned from the platform. When we talk about net income, we're talking about gross earnings. That's everything you receive, less deductions. That gives us our net income. And that's important because from a 1099 context, that's the amount that is assessed taxes on. So to be very clear, federal and income taxes are going to be based on net income, not gross revenue. So we're clear on that. We're clear on really the big points. The last point we want to say is that there are regulations that are going to complicate everything we share with you today. And the tricky thing about regulations is that oftentimes they're regional or local. So for example, New York City has a tax on all revenues received. That's going to be a local exception. Also, the city of LA, if you're located in the city of LA, you need a business license and they're going to tax all your service earnings from the city of LA. If if you are an Airbnb host, you're going to be taxed on all your gross earnings. Those happen through Airbnb. They're withheld through Airbnb. So these aren't going to fall into the net income category. Those are going to be one-off things that are related to your platform and or the city you're located in. So just understand that when we talk about taxes, we are talking about income taxes, looking at net income. And these are going to be the big drivers of the amounts that you owe. So getting right into it, the entity that you are is going to drive how you're taxed and how you report. There are really four that we consider here. The one is the sole proprietor. So this is a default. So if you do nothing and you started a business yesterday, today you are a sole proprietor. That is until you set up an entity, in which case you fall into the remaining three categories. If you set up an entity, let's say you set up an LLC, you can be an LLC partnership, meaning you have a partner, or you can be a single member LLC, meaning that you are the only owner of the LLC. This gets complicated when we talk about husband and wife teams, because depending on the state you're in, you might have to file as a partnership, or you may be able to file as a single member under one spouse. If complexity is the goal, then you might want to stick to partnership. But if you want to simplify everything, you may want to look at being a single member. That is a conversation for our entity overview video, just covered separately, but something worth noting here. Then you have the S corporation. Again, we'll talk about this. There's actually an example we'll cover on how an S corporation can save you taxes. But in short, an S corporation is an LLC or a corporation that makes an election with the IRS to be taxed as a small corporation. That's what the S stands for. And it allows certain favorable tax treatment that we'll talk about in a second. But again, all the entity types we've talked about from sole proprietor to S corp so far have been pass-through entities, meaning that all the income earned through at the individual level. That is going to be in the sharing economy, 90 to 95% of the clients that we deal with. Big to small, these are usually the most favorable structures. Then we have the C corporation. C corporation is not a pass-through entity. It gets taxed on its own, meaning it's considered a separate, entirely separate income generator. So if it earns $100, the $100 stay there. It's taxed, and if you want to pay yourself, you have to pay yourself through a dividend or a wage. So I just want to make that distinction, because really when we talk about taxes, we're really talking about flow-through entities. Those are our left three pillars. The C corporations are kind of a dark art on its own. So just something to note for now. Going over the forms just so that people are aware of what these look like, they present themselves as profit and loss statements. So if you've seen a tax return or you filed it before, a Schedule C is going to show your business name, your business address. So this is very important for people who work from home, or if you're an Airbnb host and you rent multiple locations, the address is going to be very important. Also, if you're subject to gross sales tax, like if you're in the city of LA, your address is going to drive that. Income, line 1 is going to show what you've earned, and then part 2 is going to represent all your business expenses. So again, when you look at this, you should very quickly see what looks to be a complicated profit and loss statement. And you'll see the same thing with the partnership return. So again, it's going to ask the name of the partnership, it's going to ask an address, and then you'll see the income and deductions work much the same way. The big difference with a partnership is that it's a completely different form. So it's a completely different tax return that is filed apart from your individual tax return. So if you go back to the slide that we had earlier, you'll see that it says Schedule C. That means it's attaching to your personal income tax. With a partnership return, you file the partnership. There's a profit and loss statement. It goes on its own return. And then the share of income passes through to you individually as a K1. So that K1 represents the slice of the partnership pie that is yours. Call it 50%. Then you're going to get 50 out of $100. And that's going to flow onto page 1 of your 1040. So understand that the pass-through nature still happens, but a Form 1065 is a separate tax return that gets filed if you have a partnership instead of a single member LLC. Also really important that if we're talking about tax audits and you file a Schedule C, the auditor may say, look, I'm auditing the Schedule C, but by extension, I'm auditing the whole personal return. So sometimes a Schedule C audit can drive a full individual audit, whereas if you're ever audited as a partnership, Form 1065, only the partnership is subject to the audit, meaning they're not going to look at your individual results. They're not going to look at your dividends, your capital gains, your W-2, your childcare deductions. They're not going to look at your individual because they're auditing the partnership. Now, that's not to guarantee that they won't also audit you individually, but oftentimes the distinction is very, very clear. If they're auditing a partnership, it stops at the Form 1065. So one benefit to segmenting, especially if you have multiple businesses, segmenting those businesses outside of a Schedule C. And here we show the 1120S, which is related to the S corporation. It's going to work much the same way as the partnership. So most of what I shared with the partnership applies. You can have a 100% S corp, or you can split it with partners. But in the end, you're going to pick up a share of that pie onto your personal. Now, how you file as an entity really matters, but sometimes the schedule that you file is just as important. So one of the things that we always talk about when starting a business, especially if it's on a sharing economy platform, is it passive versus active? Is it going to be reported on a Schedule C or a Schedule E? And this is a very important distinction for Airbnb. It's a very important distinction for Turo, where you're renting out a fleet of cars, is do you actively manage it, in which case the profits are subject to Medicare taxes. That's an extra 15.3% oftentimes because you're paying the employer part as well as the employee part. Now, just like the profits are more punitive on the Schedule C, the losses are more favorable on a Schedule C. So there's two sides to that coin, and it's very important that you get clear on what the tax implication is over time. Because if you have a Schedule C loss, oftentimes clients say, that's great, we're going to be able to deduct this against our W-2 wages, meaning if you got taxed on $100,000 W-2 and you have a $10,000 Schedule C loss, what you're able to do on your tax form is adjust it to say, wait a minute, I didn't make 100, I made 90, but I paid taxes on the full 100, therefore I'm going to claw back some of my tax withholding. So Schedule C oftentimes, just as a headline, is something that prospects or people who just come into our firm take and run with, and we say, hold on, let's talk about the benefit of a Schedule E, because if you do have profit over time and it can be passive, then maybe that makes a lot of sense because there's going to be no self-employment tax. Also, it sometimes makes sense if you're not going to have any capital gain exemptions to do a Schedule E, because you can take the unallowed losses against the capital gain when you sell the property. Again, that's kind of exceeding the scope of this call here, but we just want to start touching on it because the decision of how should I file this as an entity, how should I file this as passive versus active, is going to have a long-term effect that you can't just flip like a light switch later on. Now, the point I really want to drive home on any of this is however you decide to file should be reflected in any tax projections. So what you'll see here is this looks like a Schedule C. You'll see that a lot of these line up to the same categories, right? You've got gross receipts, you have operating expenses, and a lot of these align to the categories on the Schedule C. So anytime you do tax projections, it's nice that you're doing earnings less revenue. It makes more sense to align those categories to the tax categories because there's often a difference between what's reported on the books and what's reported from a tax perspective. So I want to get into what income and expenses are for the purpose of calculating 1099 income taxes. This is going to be the cornerstone and starting point for calculating any taxes you might owe, whether they're estimated taxes or whether you might have a refund. So it can go either way. First, the question is income. Income's usually easy to find, but I want to start with the most complicated version of where your income might be, and that's going to be on a 1099K. So usually when I share this in a webinar or in a room, 80% of people are going to say, I don't get a 1099K, and usually they know exactly why. The threshold for a 1099K is very high. You have to make $20,000 in gross earnings and have 200 transactions. So for Upwork, that becomes challenging because oftentimes you don't have 200 contracts that get you there. So not that it's challenging, but that it's difficult to hit that threshold. Now, it does get hit. And when it does get hit, the key is to report the gross earning numbers. So box 1A says amount of payment. That amount should match your line 1. I was showing them on the other form schedules. Oftentimes, my clients say, wait a minute, I didn't earn all of that. I say, I know there were commissions deducted and those are going to be deducted on the tax form, but do not mismatch those because that's going to raise, I'm not going to call it a red flag, maybe a yellow, maybe an orange flag, maybe it's pink. The point is you do want to match those such that what's on the tax form filed with the IRS, the 1099K, matches the taxes that you file with the IRS. And that's going to prevent any type of letter or questioning. We don't want to be special, right? So I often start there. Now, if you're an Airbnb host, again, this is going to be something that is only reflected if you have multiple properties, really, because getting to 200 stays, that's how each transaction is reported, is going to be very difficult. So what we use when there's no 1099K is we will use the gross payout files that are received from the platforms. This is an example of Airbnb. What you can see in the bottom right-hand corner is a total, but if you looked at that line by line, you would see reservations. You would see reservation at this address, right? And it's actually reflecting how it's marketed. So it usually says great 2-bedroom apartment by the river, great views. That's not very meaningful to us. What we use is we use the gross earnings column. So that's that far right. And on the whole, this host earned $20,491. So in absence of a 1099K, we would use this file as our gross receipts. The same is true if you are on a platform such as Upwork. So again, we're going to look at the total earnings and we're going to look at that number. So again, back with Airbnb, we were looking at the gross and then we deduct out the Airbnb commission fee. The same thing that you're seeing here on this Upwork screen is you're seeing Upwork earnings, and those show about, let's just call it 25,000. And then we subtract out fees. You can see there's about 2,000 worth of fees for net earnings of the difference. So again, going back to the forms that we showed earlier, line 1 would be the higher number, and then we would deduct out fees under part 2 on the Schedule C or deductions under the partnership or 1120S. So it's important that, again, we're talking about tax projections. Your tax projections should be teed up to look exactly or very closely to what the tax forms look like. So now that we've covered the easy part, we get into deductions. So deductions are critical because that's how you reduce your tax, right? So usually year 1, year 2 of working with a client, the question is, how do I maximize my deductions? And I think that's an important question to ask because it also will give you a very good feel for what's deductible and what's not. And that conversation is one that you'll have with someone like us, but it's also one that you'll have with yourself. And this is where we get into what's considered an ordinary business deduction. And the rules say 2 things. It must be necessary for the conduct of the business, and it should be ordinary. And the way I interpret that is investing or spending $1 on X will produce more Y in my business. So if I can correlate that a meal with an investor is going to improve my business, I will write off that meal. If I believe that a laptop computer upgrade is going to increase my productivity, I will deduct that. And at some level, we get to a point where you start saying, okay, well, there's some personal use, there's some business use, and I'll touch on that in just a second, but the first layer is going to be, is it necessary? That doesn't mean that could you live without it? It means, is it part of input output for me to grow my business? The second thing is ordinary. So I usually like to think of the counterfactual. Is this extraordinary for my business? So if I sell digital marketing or design or video production services on Upwork, does it make sense to buy a truck? Not for that specific business. It wouldn't, because it's all digital. Does it make sense to buy a tractor? Absolutely not. That one's a little more clear cut. That would be very extraordinary. So ordinary, I would say at the end of the day, what we're doing is we're assessing reasonableness. You can't get things exactly right, but you can get things exactly wrong. So if we can avoid that, I think that's the principle that we can stick to. So when we're talking about how to tackle tax strategy, we have our principles, right? I'm saying keep things reasonable, and we have our rules. So that's don't do the following. So if your business is Airbnb, I expect there would be some travel. There might be some research involved in visiting other Airbnbs. Should that be 50% of your revenue? It should not, right? Do the rules say you can't deduct travel? No, the rules don't say you can't deduct travel. But is it reasonable to deduct 50% of revenues from travel? It is unreasonable. So it's very important that when you're looking at business deductions, that you're balancing principles and rules constantly. On this next slide, we wanted to demonstrate what business expenses can look like. So what you can see here is we have various columns. They're each important. So we've got date, we have item detail, we have vendor, business purpose, amount. So the rules do require that we have these categories. You got to have the date. You have to have, the rules say the place of purchase, but we interpret that in modern terms to be the vendor, and the business purpose. So what did you buy that for? And you can see here, this is explained explaining what that item was for. So if you take the first example, you can see that it was some kind of pot and it falls into decor. Also important, you need the amount. You have to add these up. And to the far right, you can see that we've come up with a tax category. So that's something that we do for our clients. So we say if all else fails, write everything down within this format. You've got the date there, you've got the vendor, you've got the business purpose, and you've got the amount. Those four things can defend, and we have used these to defend audits. As long as they tie back to bank statements or credit card statements, this would be sufficiently defendable in presentation so long as you have a reasonable business purpose. And again, I'm going to come back to this allocation between business and personal. That's where things become a little convoluted, because what you have to do is you have to come up with some reasonable split between what is personal and what is business. Now, the rules do say that you can use some kind of factor to do that. So that could be a time factor, but it could also be based on reasonableness. And that's where things become, I would say, too subjective. So what I will try to do is I'll give you some objective rules for allocating things. Number one is going to be time. Time is a good indicator for allocation. So for example, if you travel and it's business travel and 50% is business and 50% is not, time is a reasonable allocation factor. The same is true with space. So if you're deducting a portion of your home office, you are going to look at square footage. Based on the square footage, you'd be able to deduct utilities. With Airbnb, it becomes even more specific. So days available and days rented. If you have a personal home that you put on Airbnb in December and you listed the upper half of your house, maybe you live in the basement, you don't get to deduct 50% of the year's worth of expenses. You have to time adjust it. It would be 1 out of 12 times 50%. And then you could take that as your allocation factor. These get nuanced. So we usually say, give it a try. I've given you a few examples: time, square footage, use is another one. So if we're talking about miles, business miles versus total, that's a good allocation factor. Either you can use direct miles or multiply that towards your actual expenses, including lease, gas, maintenance. Those are things that we assess on a case-by-case basis, category-by-category basis. But it certainly makes sense for you as a client or someone doing it on your own to have a go at calculating yourself. Again, there are specific rules. Really, when we look for rules, we're looking at what does the code specifically say we cannot do? And once we clear that hurdle, it comes down to the principles. So what would be unreasonable? So if you feel confident on those two factors, then maybe it just makes sense to get a review from an expert. And we certainly do that. We actually run these calculations for our clients at Tax Projections, but this is probably the trickiest part that I think clients get stuck on. And especially when you look at something like depreciation, that's going to be a category that's going to blow the level of complexity up on this. So at some level, it does make sense to get review and advice, though I will say there's no reason for anyone to not have a first go at calculating this out. So that covers the business and income portion of the presentation. Here, we're going to get into some case studies on how to calculate your income tax for 1099ers. So this is super important if you don't withhold. It's super important if you've incurred a lot of expenses. And it's super important if you've earned a lot of income. And here we'll look at an example of a 1099 earner. So we have gross earnings of $40,000. That's up top. Can ignore some of the middle columns. I want us to get very clear on the direction that we're going here so we can leverage that. So earnings of $40,000, expenses of about $3,000. So our operating income at the bottom of that column get us to about $37,000. So that kind of makes sense. So, okay, so we know that. Now the question becomes, well, we can look at tax on a single year basis, but it probably makes sense to look out at the future. So in year 2, what do we think the numbers are going to be? And this client says, well, 2018 was a short year. And this client says, well, 2018 was a short year. 2019 will be completely different. And I'm actually very worried about the taxes in 2019. So we say, okay, let's break that down. Let's figure out what expenses we might have in 2019. And conservatively, we came up with something like $13,000 in expenses on $230,000 of income. So it's a very high level of income, very low level of expenses. And And you can see here that we look at the operating margin. If you look at the very, very bottom right-hand corner, you'll see it's about 94%. That's a very high percentage for a service business, but it's not unreasonable. And it's a very important metric and something that we actually benchmark. So if you're in this industry and you're a software developer, like the client in this example, and you have an operating margin of, let's just flip this, 6%, you're probably going to get flagged. Because if you look at the market for software developers, and if the IRS looks at the industry code that you've put on page 1 of your return or on the Schedule C, and they benchmark that against other industry code filers of the same code, they're going to see a huge discrepancy in operating margin. So, and I even told this client, you're probably on the high end, but it does a good job of demonstrating tax savings because it's going to generate a lot of tax. As you can see in this year, it's going to generate something like $11,000 in tax just on this segment. And that might be manageable. But at the same time, the question is going to be, well, what does this tax mean over time? And in this case, we said, if you do nothing else, next year, your tax is going to be $82,000. So 8 times what it is in 2018. And a client in this position who has us right there would say, how do I get around this? Or what can I do to improve my tax situation? So on this next slide, we're looking at a more detailed version with a different set of assumptions, but the same numbers. You'll see that 216,930 looks familiar. So we look at what the tax implications might be on an LLC versus S Corp. So the big point to note here is we've run the baseline numbers. We've calculated incomes less deductions, and we've calculated in self-employment tax and federal income tax. And we're doing the same thing here. So you'll see we've got something called payroll taxes. It's the same thing as self-employment tax. And you can see here that we have an income tax assumption at 30%. So again, 2019 on 216 of income, and based on these assumptions, you can look down about 5 numbers down and you have 48,463 in income tax, 23,890 in payroll tax. Sorry, I did that backwards. So 23,890 followed by 48,463 gives you a total tax of 72,353. That's an ETR, effective tax rate, of 33%. Now, no one's surprised by that because those numbers are generally accepted. 33% in total taxes. Okay, you got me. So if you said, hey, how much of my income should I be saving? I would say if you want to be really conservative, you're not going to do anything and you're going to sit on an LLC, 33% of your net earnings, that's gross less deductions, should be withheld. You should put that in a bank account. Best advice I give to people is Goldman Sachs has a 2% earning interest savings right now. Go out and get one of those, and every time you earn $1 of net income, go ahead and put 33 cents in that account and see how that adds up at the end of the year. But what if you want to do some tax strategy? What if you want to get that number down? And that's where we get into an S Corp. So you can see in this column, and most folks watching this have already jumped ahead and done the math on this, you would run a salary of $60,000. So you say, okay, I will take it on the chops for the payroll taxes on $60K. I will issue that as a W-2. My operating profit is going to be less than $60,000 now. So if you take 216, you subtract 60, you'll get to 156. So the total income is still the same. However, you'll see the taxes on this are different. The payroll taxes are going to be that 15% on the 60, and then the income tax is going to come out. I just have it showing as the same, but if you just look at the difference in the payroll taxes, what we're talking about at the end of the day is a delta of about $15K. So $15,000 in taxes saved. Again, we've assumed a high amount of income, a low amount of deductions, but that's just one example and one strategy where we take the principle, how do we calculate deductions? How do we calculate income? And we take the rules around S corporations and we look at what the goal of the client is. In this case, this individual wanted to post high income because they wanted to get a house. So this individual actually was doing software development as well as Airbnb, and they wanted to post high income on their tax return so they could finance a mortgage. One thing for our clients out there that just want to maximize deductions every year, it's going to hurt you when you go out to buy a house. So it was important that we took the letter of the law as well as the big vision the client had, and we married those two to conclude on a tax strategy, which is an S corporation. You have the tax deduction, you still post the high income, you save $15,000 of tax. At the end of the day, you're going to look pretty good for a bank. That covers how we calculate and estimate taxes for our clients. It also covers some of the strategic approaches that we take to planning and the forward-looking approach we take with clients. If you have any questions, our contact information is up here. Sean at our firm handles all client intake. You can reach him at sean@sharedeconomycpa.com. You can also connect with our company by clicking on the URL shown on the screen or going to sharedeconomycpa.com/get started. Again, thank you so much for connecting. We look forward to connecting on the other side. For clients who stayed to watch this 1 extra minute of presentation, we have a very special coupon for you that we're showing on the screen. Use code 50off.today.only. You can use that if you reach out to us and ask for a get started link. We'll send you that as well as the coupon code. So we'll look forward to connecting again. Thank you so much for your time. It's been a pleasure.